So for those who don't know me, my name's Luke. I'm the CEO and investment advisor here at Seneca. This is our Q2 webinar, and I'm here today with my colleague Ben Richards. Ben's the co-PM on the two direct share portfolios. Sorry, Benny. We run these every quarter, normally a few weeks after the end of quarter, with end of financial year. And there's always a reason we're late. We always seem to be late, but we try and get these up as quickly as we can and get them organised. As I said, 20 or 30 minutes, pretty informal. Ask questions, and we do record the session, and I'll stick it on YouTube at some point. So just be aware of that. We run an investment committee at Seneca. It's made up of myself, my business partner John Bailey, as well as Gavin, Ben, and Sam, who are independent of us. While Ben and I do the stock selection for the individual share portfolios, the multi-manager strategies and the overall governance of our entire investment process here at Seneca is run by the investment committee every month. So, we're forced to kind of articulate our ideas, our strategy, and support that, I suppose, with evidence to them. And even though they might not be experts necessarily on every stock in the portfolio, they're certainly experienced and really smart people who can ask us good questions and maybe, bring another angle to the way we think about things. So it's a really important part of what we do here at Seneca. As I said, we do run sort of 7 distinct portfolios. We've got the 2 direct share portfolios where we actually pick the underlying shares. So the Seneca Australian Shares SMA, that's 20 to 40 companies from inside the ASX 300. And for wholesale clients, we've got the Seneca Australian Small Companies Fund. That's 20 to 50 companies from kind of anywhere over the ASX, with a sort of distinct focus on small caps and emerging companies and, all the stuff you're always hearing us talk about. Outside of that, for our clients who need advice and ongoing support, they need exposure to global equities, they need exposure to fixed income and other asset classes, alternative asset classes. So we're not experts in every single asset class at picking investments, so we outsource to other active managers, and we do that across the other asset classes and the multi-manager strategies. There are some really good benefits to SMAs, or separately managed accounts, the way that we invest here at Seneca. For our clients, I'll probably, you can review this maybe in your own time, or if you want a copy, you can always email me. But I just like the individualised tax treatment personally. I think that's great. And I love the fact that I can run everyone's portfolio bespoke for their particular asset allocation, but everyone's getting our best ideas at the same time, at the same price every day. And I know that every one of my clients is invested perfectly, exactly how I want them to be, and exactly aligned with their goals every day, regardless of whether we change our mind today, tomorrow, or any other time. So yeah, that's a really important benefit of SMAs and the way we do things here at Seneca. I'm going to roll through these multi-manager strategies today. Like I said, we've got heaps to talk about from a stock specifics perspective, and I know that's what everyone's interested in and always bangs on to me. That's what they want to talk about. So we'll just get through these kind of today. Aussie equity SMA had a pretty good month, 8% returns. It's been a pretty tough market for active managers, but starting to turn now. And I think that's going to mean revert in due course. We made a few changes across the portfolio, just with the Benelong emerging company strategy coming in and the Macquarie one, which has been with us for a long time, coming out. Aussie equity, like I said, we've done 8% for the quarter, so reasonably good positive returns. Active managers have been struggling across the board, which, makes it hard, I think, when CBA is doing the returns it's been doing. Some of the large cap stuff going on, I think that's going to mean revert in due course, as I mentioned. In the global strategy, US growth and momentum was pretty strong for the quarter. And, that's not really the way that we like to invest, or the managers that we like to choose like to invest, I suppose. Probably had a really good quarter last quarter and a little bit underperformance this quarter. We did make a pretty significant change. We took the GQG global equity strategy out for the first time in a while. And we bought in some more emerging markets exposure, as well as PM Capital, who are a little bit more into some of those growth and momentum names and a little bit less defensive. As our view is markets are going up at the moment, and we want to be part of that, want to be participating. In the aggressive income strategy, pretty solid quarter. And it's really performing kind of as we designed it to do. It's generating really high levels of income, really good yield for investors there, and it's kind of keeping up with markets, which is sort of the way it's supposed to work. 7.5% the last couple of years is really good for the type of investing that we do here, which is across sort of high yield securities, 25-30% in the markets, and then the rest in sort of high income fixed income. Defensive's doing what it's supposed to do. Very rarely does it have a negative month. It's done 6.45% per annum for the last couple of years, beating its benchmark. Really good returns for defensive positioning in your portfolio, and a lot of my clients use this as a portfolio diversifier. I think it's a really good way to get broad-based exposure to fixed income, and some negative correlation or low correlation with the equity markets. Absolute return has probably been our main issue with our multi-manager strategies at the moment. We've had these diversified futures managers, really struggling with the sort of whipsaw change in direction of the market. They're kind of trend following, and they kind of struggle when Trump's kind of putting out news and changing the direction of the market, and then the market's coming back the other way. So they've really struggled. This is an absolute return benchmark, so it's a pretty hard one to chase. But we're pretty confident in what we're doing here, and we're a little bit limited sometimes as well with the products we can choose and the platforms, but that's improving. We've got probably a change for this investment committee coming up to this portfolio, so we'll keep you posted on that next quarter. From an outlook perspective on the macro, and this will leave me or Benny, just to run off for the stocks from here on out. Nothing's changed. When I updated this slide, nothing has really changed from last quarter. We're still positive on Australian equities relative to the rest of the world. We're still positive on small caps relative to large caps. We think that the pro-cyclical and mining names are particularly attractive and offer a lot of value. And we're continuing to be overweight emerging markets across equities and fixed income. I think that from a macro perspective, most developed markets are probably at peak interest rates, probably falling now in most markets. And we've got this kind of potential China stimulus thing, which, whenever that does eventuate, I think it's not a case of if, but when. That's going to be fantastic for resources and the Australian economy more broadly. I think investors are probably a little bit too concerned at the moment, a little bit too bearish, and probably need to start asking themselves again, what can go right? All right, Benny, all yours, my friend.
Excellent. Thank you, Luke. We'll start with the Seneca Australian Shares SMA, which is going quite well still. 7% returns for the quarter is nothing to be upset about, as we've written there. A little bit behind the benchmark. We've kind of talked about some of the key drivers in the past, and in ongoing commentary and things like your weekly note. Commonwealth Bank of Australia is obviously one drag there. In general, it's probably a trend towards these kind of expensive defensives up the top there, top end of the market there. But yeah, we're kind of quite positive on the outperformance in July, which we think should sit around 3%. So stay tuned for your monthly reports dropping in the next week or two. But it's just really good validation of sticking to the process and the long-term returns that we are confident that will deliver. And yeah, just continue to kind of stay disciplined, and yeah, we believe that'll be the best outcome to drive long-term outperformance for clients. So on a kind of topical basis, what's happening in the portfolio at the moment? It's obviously leading into reporting season in August. We've just had REA Group, realestate.com report this morning, which we thought was really good. The key drivers there, they continue to kind of drive yield growth within their business, and the market's responded positively to that, so that's good. But yeah, during the quarter, as always, we've listed the contributors and detractors. I'll talk to Catapult as one contributor for the quarter, which it actually reports out of cycle. I think it reported in May. They reported really strongly. It wasn't just the kind of 19% revenue growth up to $185 million, but the key for them, key metric, was the incremental profit margins of 65%. So each new dollar of sales is increasingly trickling down to the bottom line for Catapult. And that's, been a really strong performer actually in both funds, small and large. as the stock has kind of proved to investors and demonstrated growth, inflecting profitability, and continuing to retain that strong market position and different revenue drivers, including kind of winning new professional sports teams, as well as upselling existing clients into kind of more products. So that's been a really strong performer. On the detractor side, I'll call out Botanics, which has been quite weak. Fortunately, we actually sold that prior to its large downgrade. It still dragged on returns a little bit, but yeah, they raised capital at a discounted price, which was kind of a major red flag for us, given that they're ramping up their drug sales of their lead product Sofdra, and we kind of thought that would be they had enough runway to at least get close to profitability on their own, and then they came out and raised capital, and market was still pretty excited about it, and it traded up from that raised price, and we took the opportunity to kind of take our money out of Botanics there. So fortunately it saved us from the worst, but there's always, can't get them all right, and there's always a few kind of minor detractors in there. So overall going really strongly. A couple of changes in the portfolio over the quarter. Probably main ones to call out, we've added Bellevue Gold, which is a high-grade gold miner in WA. It's fallen out of favour with the market as it kind of ramps up production. We think that's a takeover target. It's a strategic high-grade asset, which is quite scarce in the Australian market, and could be particularly attractive for an overseas major gold miner, or even an Australian producer looking to replenish their ore stocks. Also, we've added Challenger. Luke wrote that up on Livewire a few months back, I think. So give that a read if you're interested in that one. I mentioned Botanics and a couple of other gold names, Genesis and Gold Road, which we took profits in. Genesis has run really strongly. Gold Road is under takeover. So yeah, that's pretty much the overview. I'll get into the stock specific that we own in the SMA, being PEXA. PXA is the code. For regular kind of clients and followers of the work we do, they would have seen us talk about PEXA in the past. It's just shy of $3 billion market cap. It's a property conveyancing platform. It's got a monopoly presence in Australia, circa 90% market share, and is also expanding to the UK, rolling out kind of the same playbook in a similar legal jurisdiction in the UK. And it's been a bit of a slow burn, so we put up a couple of charts there. It's traded at a discount to other property platforms, and yeah, the market has kind of been penalising PEXA ever since its IPO in 2021, which was at $17 a share for this UK rollout, with kind of question marks as to whether they can get traction and turn it into a profitable business over there. So the main development here is that they've just signed up NatWest, which is a large UK bank. It's actually larger than CBA is in Australia, to their sale and purchase product, which is twice as profitable as their remortgage solution, which is kind of the foot in the door. And now that they've signed up NatWest, it's a real green flag for potentially signing up more banks, which are kind of queuing up behind NatWest, first through its remortgaging platform product, and then into its more profitable sale and purchase product. So it's just really shining a light, I think, on the value, the latent value in PEXA, where the core Australian business is probably worth $15, $16 on its own. And then the UK market, that's the question mark, but it's a 3 times as large market size over there. So we think kind of institutional investors are sort of waking up to this now, and it's pleasing to see the stock re-rate a bit during the quarter, but still plenty of upside on our numbers. Over to the small companies fund, 8.4% net returns for the quarter after fees, and yeah, another really strong quarter for the fund. So yeah, again, thanks again for the support we've been receiving from existing and new investors at the moment. It's been really pleasing to see. And it may sound like a cliche, but we really do think that the embedded value on the portfolio is really attractive. Had someone ask me the other day, the market's run a bit, is it a good time to invest now? And as Luke and I were discussing this morning, it's the kind of thing where if we can't find value, can't find good ideas to make money, then what are we doing? So, there's still plenty of value on offer in the portfolio. Contributors, Catapult, we talked about. Antipa and Minerals is another one which, followers will have seen we've talked about before. AFG is in the property market, mortgage broking space, and it just kind of shows that, it's not all one type of idea that's working at the moment. It's kind of individual stock-specific catalysts. It's kind of different ways to make money, particularly in that smaller end of the market. Tractors, all relatively small. Botanic's kind of touched on a bit as well. And they all tend to be smaller weights in the portfolio. Changes, I've chucked in Infomedia there, which is a bit cheeky, but it's highly topical. It's just subject to takeover offer this morning. We bought this at an average price of around $1.21 per share in recent months. They've just come out with a private equity bid at $1.72, I believe it was. Cash takeover bid. This was kind of an undervalued tech name, software for automakers and dealers. Really strong product, mission critical product, good market share, but mature company. And as such, it kind of just, people fell out of love with it. It's not the most exciting company on the ASX, relatively low growth, but, when you combine a few new products that they've been investing in, which should drive growth going forwards and strong margins, it's the kind of company that on a 16 times PE is a bit of a no-brainer for private equity to come in and try and make some money out of. So, always kind of looking at new ideas. VBX was a bauxite IPO in the resources space, and a few others there that probably can't go into all of them on an individual basis. But as you can see, we're constantly kind of positioning the portfolio where we think the best expected returns are. And particularly going into reporting season, that's critical. Where it's a catalyst-rich time and a good time to make some money for investors. Just diving into one of the stocks in the small caps fund, there is Qoria, QOR. Qoria sells software to schools for monitoring kids' cyber safety, which is increasingly a priority for schools and parents in the digital age. Kids have access to the internet via various devices. Qoria has reached the profitability inflection point while still maintaining strong growth. So it's a bit like, you can think about this a bit like Catapult in 2023, which ended up re-rating from 2 times sales to 8 times as that profitability inflection became obvious to investors over the kind of subsequent 24 months. We think exactly the same thing is playing out here with Qoria. It's a business that it's actually the old family zone. We've kind of never owned it in the past and been a bit skeptical on it, waiting for it to kind of deliver that critical mass and which drives operating leverage. The stock has barely traded above 40 cents, which was actually the cash takeover bid price received in April 2024. But I think the market was just waiting for kind of confirmation that this business is delivering as they say they are. And they've just reported their quarterly numbers, and really pleasing result again for investors, where they're talking about 20% growth and 20% margins essentially, which you may know as the rule of 40, which those kind of companies trade on, over 7 times EV to sales. Qoria's trades at a significant discount. It has re-rated a little bit over the last few weeks, but it's a position we continue to hold and think the outlook is quite good for that stock. So, although the names like Life360 might grab the headlines and all the fund managers talking about that one, at the current prices, there's a bunch of other kind of smaller companies or different companies which we think have a lot stronger expected return profiles to them. So I might just throw back to Luke and we can go through any questions you may have.
All right, I'll maybe stop sharing and we'll just do Q&A. Alan wants to know how often we send updates on our small companies fund. Once a month, mate. So we do the monthly fact sheet as part of the performance pack, which has got all the product in there actually that gets emailed out. It's monthly priced as well. So we'll get that out over the next couple of weeks. It's externally adminned, so I can't really do anything about how long it takes.
So each intake is first of the month for the small caps fund. So
Yeah.
1st of September will be the next.
So, 1st of September's next opportunity to put money in. You'll get a price as at 1st of August, and your returns and stuff are all calculated on that. So that's the go there.
Thanks, guys, for the presentation. I just had a question about Monash. Why you still hold that, given all the negative news out there?
Monash IVF. Well, I mean, we bought it pretty well. And then we bought more pretty much at the bottom when everyone else, and it's gone up, I don't know, 20 cents since then. So it's going okay for us on sort of on average. But yeah, we think that business is intact. We don't see any sort of material changes there. From an earnings perspective, I think the sentiment against that stock will turn over time. And new management are going to come in and probably put a few governance and regulatory type sort of systems in place, and make everyone happy with it again, and continue to re-rate. So yeah, no real issues for us there. Pretty comfortable, and yeah, happy to own that at the moment.
So that's a recent acquisition, is it?
We've owned it. Well, we've owned it over the journey at different times, but yeah, we bought pretty well during the bottom there. So
we added to our position. It's also probably an insurance factor. So obviously there's risks associated with it now. How have they been priced versus how we think they're actually exposed in terms of a market share and an insurance coverage perspective. We've kind of stacked all that up versus how much the shares have sold off, and think that it's quite a strong investment case from here.
Barry wants to know which of our stocks had the biggest drawdown for the quarter, individually or for actual portfolio attribution. I think Botanics is probably the biggest one from an attribution perspective that cost us the most money for unit holders.
Yeah, so those detractors in the slides, I think, were biggest.
Biggest moves.
Moves dollar wise, yeah.
But yeah, I mean, pretty good quarter. So it's sort of, you do 8% for a quarter, you're not going to have a lot of drama. Wouldn't mind an update on Stanmore. Not sure if held in the fund, so feel free to ignore. No, we like Stanmore, and we're looking at it. We don't own it at the moment, but we're always looking at it. We like management there, and good assets. So probably just a bit. Coal's tough at the moment, really tough. Pretty much those stocks are all trading like. I mean, Coronado is the one that's sort of, coal leveraged on speed. Stanmore, a bit higher quality, bit lower cost, lower than the cost curve, bit better management, or a lot better. And so, we like it. It's just not in the portfolio at the moment. AZY, Hayden Buck. Oh, this is a Luke Laretive special. Hayden, I'm sure I didn't pay you for that one. All right, so look. That Greatland Gold call, the earnings call, was one of the most badly run earnings calls and, bad responses I've experienced in my career. From what my understanding is and interpretation of what they've put forward, they only need to buy Antipa more. It used to be like they should buy it from an economics perspective. I think my views now changed that they have to buy it. Like that, otherwise they're going to be eroding millions of dollars, billions of dollars of shareholder value. So I think on the back of that result and the back of that deal, it is more likely, not less likely. In fact, I think it is way more likely that deal happens, and I think it happens sooner rather than later. We've bought more stock in Antipa just recently. I think that looks like a really good deal at the moment. I don't think they sell for anything less than $1. Liam, thoughts on Red Hill? MinRes is ramping back up. Yeah, we still own Red Hill. We like it. It's a good business to own a royalty on a project that's ramping up production. I don't think that one's that one's not that hard, not rocket science there. So, all right, that'll do us. I need to go have some lunch. Ben looks hungry. He always looks hungry. Look, appreciate everyone, coming along, being patient with us, and just being interested in our business and what we're doing. We're very grateful for all the support. If you've got any questions afterwards, or you want to have a private chat with me, feel free, how to book a meeting and go from there. So look, have a great day. And again, I just appreciate your time and support. And yes, Pete, we still like XRF. So cool. Thanks, guys. Appreciate your time.
Thanks, everyone.